The largest institutional landlords in America are trading at a 30% discount to what their properties are actually worth. If you've ever wondered how to buy real estate at a discount, this might be the moment to pay attention to. So right now, something unusual is happening in the real estate market, and nobody really outside of Wall Street is even talking about it. The big publicly traded companies that own single-family rental homes, names like Invitation Homes, American Homes for Rent, they're trading at prices that are dramatically below the actual value of the properties that they own. In finance, this is called trading at a discount to net asset value, and historically, this kind of dislocation does not last forever. But here's the catch. The reason these stocks are under pressure is not just the interest rate environment. It is something newer and more complicated than that. Washington is coming after institutional landlords, and the proposed legislation, it could fundamentally reshape who is allowed to own single-family homes at scale in America. And believe me, these are calls I'm taking every day because we work with several different institutions and family offices. That is not a small thing to be faced with who is allowed to own single-family homes and for how long. And investors who do not understand both sides of this story, they're going to be flying blind right now. This is something that needs to be understood. I'm Jim Sheils. I've been investing in Florida real estate for almost 25 years, Wall Street Journal best-selling author, and I've spent a lot of my career building rental communities that serve families the housing markets keep failing. And I've watched for market dislocations and seen them come and go. And what I'm seeing right now, it has some real implications. That's for anyone who owns, rents, or invests in residential real estate. So here's what we're covering today. First, we're going to break down what's actually happening in institutional real estate and why these companies are trading at such steep discounts. Then we're going to look at the political risk that is driving this dislocation and what the proposed legislation actually says. After that, we're going to talk about why is Florida the center point of the private market opportunities this creates? And finally, we're going to walk through exactly why the build-to-rent model that Southern Impression Homes is doing is built and positioned differently than institutional players under fire right now and how you can capitalize on that. So let's start with the numbers because they are striking. According to data from Second Market Capital, the average REIT across all property types was trading at roughly a 15 to 18% discount to net asset value at the close of 2025. That means that you could buy a dollar's worth of real estate for about 82 to 85 cents through the public market. For single-family rental REITs specifically, that discount has been even steeper, driven by a combination of interest rate pressure and growing legislative scrutiny. Net asset value, or NAV, simply the estimated market value of all the properties a company owns minus its debt. When a publicly traded company trades below NAV, it means the stock market is pricing in something that private real estate markets are not yet reflecting. And sometimes that discount exists because investors are worried about future earnings. Sometimes it reflects a liquidity premium, that the facts that public stocks can be sold instantly when real estate cannot. And sometimes it reflects genuine fear about policy or regulatory risk, which is the main point of what we're talking about today. In the case of single-family home REITs right now, all three of those forces are at work simultaneously. Interest rates remain elevated, compressing earnings relative to what these companies were producing when rates were near zero. Fidelity's real estate team noted that single-family rental stocks meaningfully struggled in 2025 compared to stronger performing REIT sectors. And on top of that rate pressure, there is a wave of proposed legislation in Washington that has basically spooked investors who worry about what large-scale institutional ownership of homes might look like in 2 or 3 years. This is a classic market dislocation. The underlying assets, actual homes and real estate markets with real tenants paying real rent, have not lost 30% of their value. The stocks have. And that gap between private market value and public market pricing, that's exactly the kind of situation that sophisticated investors study very carefully. Now, let us talk about the policy side because this is where a lot of commentary gets sloppy. The political pressure on institutional landlords is real, it is bipartisan, and it is not going away. The 21st Century Road to Housing, which cleared the Senate with an 89-9 procedural vote in early 2026, that includes specific provisions targeting large-scale institutional buyers of single-family homes. This is not fringe legislation. It passed with overwhelming support with both parties because it is politically popular on both sides. The core concern driving this legislation is straightforward. Over the past decade, large institutional investors have purchased hundreds of thousands of single-family homes across the country, particularly in high-growth Sunbelt markets. Critics argue that this has contributed to rising home prices and reduced the inventory that's available to individual buyers and families. Now, supporters of the legislation say it's time to put guardrails on how many houses any legal single entity can own. And regardless of where you stand on this debate, the policy direction is clear. Some of the more aggressive proposals on the table would require institutional owners to sell single-family homes back to individual buyers within 7 years of acquisition. Others propose restricting any entity from owning more than 350 single-family homes in a given market. A Narrate analysis summarized the situation by noting that single-family rental REITs faced heightened scrutiny from Washington, calling it negative but not catastrophic for the sector overall. The key phrase there is overall, because the impact is very different depending on the scale and structure of who actually owns the homes. This is a genuine policy risk, and it deserves to be taken seriously. Investors that believe that these proposals will never become law are making a bet that Washington's interest in housing affordability will fade. I don't agree with that. And given that this is one of the few issues generating an actual bipartisan support in an otherwise deeply divided Congress, then I don't find this to be a very safe assumption. Here's where the story shifts from risk to opportunity, and it is a shift that requires understanding from one of the oldest principles in real estate investing. When public markets reprice an asset class downward, private market fundamentals do not always follow. And the homes that institutional landlords own in Jacksonville, Tampa, Orlando, and the growing markets across Central Florida are not worth less today than they were a year ago. The stocks are what are worth less, and the assets are not. That divergence between public and private valuation is a signal that the experienced private market investors recognize immediately. As BlackRock's real estate team has noted, when public REITs trade at discounts to private market values, it often signals an opportunity for allocators who are comfortable with illiquid private structures to express the same exposure at a discount. In plain English, that means what the stock market is discounting private investors, they can often access at better terms by going direct. Florida sits at the center of this opportunity for several specific reasons. Population growth from high-cost states continue to drive qualified renter demand in Florida markets. Construction efficiency in Florida continues to give builders a timeline advantage here over virtually every other growth state. And critically, the supply shortage is structural, not cyclical. According to the National Association of Realtors, America is still short approximately 4.7 million homes. And that shortage does not close because a few large REITs come under legislation pressure. The demand is here, and it is here to stay. The institutional dislocation, well, actually, that opens a lane that was harder to access than before. Large players pulling back or facing forced repositioning creates opportunities for community-scale builders to move into markets where high-quality rental housing is in demand and it's not being met yet. This is not a theory. This is what happened after every major institutional pullback in real estate history. And the private operators who move intelligently during these windows, well, they captured some of the best returns of their careers. Now, let us be direct about why the model we have built at Southern Impression Homes is structured differently from basic institutional players facing the political and regulatory pressure right now. The legislation targeting institutional landlords is aimed at large entities that acquired existing homes at scale, often outbidding, removing individuals from competitive markets, and that took the inventory over from the for sale supply point of view. And that is a specific business model, and it's under a lot of political fire. What we build is fundamentally different. Southern Impression Homes constructs purpose-built, new single-family duplex communities and scattered lots designed from the ground up. That's for families who want the experience of home ownership without the financial burden of buying at today's mortgage rates. We are not buying up existing inventory. We're adding new inventory, new supply to the markets that are desperately short of housing. That distinction matters a lot. I mean, it's enormous under the proposed legislation, which includes explicit exemptions for newly constructed build-to-rent properties and communities. Families we serve are not going anywhere. They're remote workers from New York, California, relocated to Florida for lifestyle and affordability. They are the families who want a yard, a garage, a real neighborhood, a school district that they choose intentionally. They have high credit scores, 24-month lease commitments to them, and they represent qualified renter base in the country. No amount of Wall Street volatility or political legislation changes the fact that families need a place to live and that traditional rental market is not equipped to provide it. And the construction economics in Florida remain compelling in ways that are hard to replicate in any other state. Permitting timelines that take months elsewhere only take weeks in Florida counties where we operate. Labor and material infrastructure is local and efficient, and the all-in cost to build a quality 3-bedroom rental home in target markets still pencils at a basis that generates a strong return even in a higher interest rate environment. The institutional disruption is real, the political pressure is real, and the opportunity for the right kind of build-to-rent in the right markets has never been more clearly defined. So here's the bottom line on everything we just covered. Public single-family rental REITs are trading at significant discounts to the actual value of their underlying properties. That discount? Well, that's being driven by elevated interest rates and a genuine wave of political pressure that's targeting large-scale institutional landlords. Some of that legislation proposes forced sales and hard caps on how many homes any single institution can own. This is a classic dislocation, and classic dislocations create two things at once: real risk for investors who are not paying attention and real opportunity for those who understand the difference between what is being repriced and why. The underlying demand, though, for high-quality single-family home rentals and duplexes in Florida, that's not going away. What is changing is who builds it and who owns it. And that shift is creating a lane for community-scale builders and investors that did not exist with the same clarity before. If you want to understand exactly how we are thinking about environments at Southern Impression Homes, including the specific markets we're focused on, the legislations coming up, the construction models that is being worked in right now, and why build-to-rent still has a very unique way to look at things completely different from what Washington is targeting, especially for those smaller scale investors, just drop me a few questions and I'll try to answer them in next week's video. And this gave you anyway a clearer read on what's happening with institutional real estate investing and just kind of the trends. Hit subscribe, because every week I'm sharing things right in this field of BTR, institutional investing, and how the smaller investors can actually profit as long as they're paying attention to what the bigger guys are doing. We're seeing what's on the ground right now. I want to share that with you, not the headlines, but the intelligent information that's really going to help you make the right investing decisions.